The Rebel Capitalist Show. All right, guys, it gives me a great deal of pleasure to welcome someone back to the Rebel Capitalist Show. I haven't spoken to this person in, Tracy, how long has it been?
Years.
Well, I remember the last time I spoke with you, I was on the way to St. Bart's.
Yes, and you were trapped in a hotel.
Yeah,
it was during the pandemic.
Yeah. So that would have been like probably July of 2020.
Yeah.
So yeah, all right. Well, it's great to have you back. Tracy Shuchart is here on the Rebel Capitalist Show. So, well, congratulations first and foremost on your deal with Steve and Snyder. That sounds really, really exciting. I think the three of you together, it's going to be awesome for the subscribers because each of you brings such a unique angle and expertise into the equation.
Yeah, I mean, I think so too. I mean, we've got the equities, we've got commodities, we've got bonds, we've got euro dollar. So we cover the gamut, I'm really excited about the project. So
that's really cool. So I was just going over your Twitter feed to kind of get some questions. And obviously I want to talk about energy and gas and oil and all that fun stuff. But I think the most shocking thing I have seen in the news recently is that Domino's actually tried to go into Italy. I was like, what? Yeah, I think on your Twitter feed, you said in the least shocking news of all time, Domino's pulls out of Italy. It's like, whose decision was that in the management team at Domino's to try to go in and tackle the Italian market?
Right. And literally like the worst pizza. In the U.S.
Yeah, you couldn't have even taken a good style of pizza or a good brand of pizza in the United States. You had to take the worst one and go up against the Italians. My goodness. If the viewers, if you haven't been to Italy, I can tell you right now, the food right there is absolutely phenomenal. It is quite a bit better than Domino's pizza.
A little bit, just a little.
Yeah. All right. So give me your thoughts on what's happening in the energy space. I mean, my goodness gracious, the last 6 months has been just incredible, isn't it? And just give me your ideas.
Yeah. And so, well, I mean, obviously, we saw, big spike up in oil, at the beginning of the Russian-Ukraine invasion, right? All of that, basically risk premium has been taken out of the market, which is a good thing. That was too much too soon. And right now we're kind of sitting at, we're kind of coming off a little bit. I think the SPR really is starting to impact the, at least the WTI, the US domestic market.
Do you want to go into that just a little bit so the viewers understand the strategic petroleum reserves? I think what you're referring to. What Biden's done is he's taken that and sold it out into the market to try to reduce the gas prices, basically to buy votes. So how long has that been going on? What did they start with?
They started last fall. They started in November. The first announcement was in October. We had basically at the end of the year, there was like an $80 million or 80 million barrel release. Then they announced a second release. So plus the 80, they added another 100. So it was 180. And then just now, a couple of weeks ago, they announced another 20. So it'll be 200 total, which literally places us in danger zone.
Why is that?
Because the reserve was created in the 1970s after the oil embargo and the energy crisis then, so that we would never have to be in that position again. And the thing is that high oil prices, high gasoline prices, that's not a crisis. The crisis is when we're actually in gas lines. So, my feeling is that, I've been very outspoken against this SPR release because literally we're not in an emergency. When we're Europe, that's when we're, going to be an emergency. And so the problem is that right now, the U.S. mostly produces light sweet crude. We do produce some sour crude, but not that much. So what we've been releasing is sour crude so that we can mix it and blend it and make the distillates and things that we need. But but that's what we mostly import from other countries. So the problem is that when we have a problem, we've taken all of that out of the market. In fact, for the very first time, sour crude is actually lower than sweet crude in the SPR. So it's getting very worrisome because, again, when we have an energy crisis, and I'm not saying what's happening in Europe is going to happen in the US, but it's very possible that we could see that, 23, 24, depending on how things are. So I just think it's irresponsible, just because to bring, release 200 million barrels to bring down gas prices 83 cents is
Yeah.
a
The
little bit
cost benefit
insane.
analysis really doesn't make sense. But I mean, go into that a little bit further, what you were saying with the sour, the sweet, because I was talking to Townsend regarding this maybe a couple weeks ago, and he was saying effectively that it's kind of a fallacy that the United States can be energy self-sufficient when you look at oil, because although we may produce a lot of oil here, we have to mix it with things that we have to import for it to actually be usable. And I don't think most people get that.
What they were calling energy independence really was being a net exporter, not that you're not importing anything. So
Right.
that's their definition of being energy independent, but it's not technically independent. I mean, there's global oil flows. Everybody's trading oil with somebody else because they make something that they don't make. So, we're still importing a lot of oil. We had to because we don't produce the kinds of oil that we need to refine, because we need distillate products here as well. So
Still, you're talking about diesel.
that's kind of the fallacy, which I've always kind of pushed back on, is, energy independence is just by their definition a net exporter.
So as far as prices, I've noticed recently oil, I mean, we got up to, I think this is what you're talking about, the risk premium, up to what, 130 or something like that. And then we kind of drifted back down to the low hundreds and into the 90s. And then recently we've been down, I think, 87, 88, something like that.
Yeah, we're about 87, 88 right now.
Yeah. So do you think that the decrease in price is just the Russian risk premium going away, or does it also have a lot to do with the market predicting lower aggregate demand moving forward?
Well, I think it's a lot of things. I mean, I think it's recession fears, right? And global recession fears. I would push back on that and say demand is really relatively inelastic.
Okay.
So, because if we look at the great financial crisis, like 2008, right? We were producing about, we were consuming about 85.8 million barrels at the time. Then we saw 2009, our consumption only dropped by 1.5 million barrels a day. And by 2010, we were already back up higher than 2008 levels.
Okay.
So, demand is kind of relatively inelastic, even though, we were still in the midst of, a financial crisis during that time. I think it's recession fears, first of all, but I would push back and say demand is relatively inelastic during those times. I think it's risk premium taken out of the market. Obviously, with Russian, there's a lot more Russian oil on the market than they originally thought. The original estimates were between like 3 and 4 million. We're really just not seeing that because you have buyers in, you have China, India, UAE, buyers in Africa, buyers in South America that are that don't have sanctions against Russia, that are taking up those extra barrels at this point.
Yeah, and I noticed on your Twitter feed, you're talking about India trying to get around the sanctions by what were they? They're taking dollars and they're trading them for rubles to buy the oil directly from Russia. Is that, or yuan? What are they doing?
They just set up a trade with rupee. Actually, they'll be able to trade in rupees with them.
Okay.
But they have been, trading in rubles. They just started trading coal. They're buying a lot of coal. So they just started buying coal in yuan and the Hong Kong dollar. So, but really all that is they're exchanging dollars
Right.
for those currencies and then purchasing them from
Right.
Russia.
So they still need the dollars to begin with.
Right.
Yeah, that's interesting because at surface level, you would think, oh, well, this is bearish for the dollar because of less demand. But at the end of the day, it's still the same amount of demand for dollars. It's
Exactly.
just you're just having to do 2 transactions instead of 1.
Just swapping it out to avoid sanctions, basically.
Yeah. All right. So let's go into the European energy crisis and what they're facing right now and what you think they'll be facing when we get into the winter months.
Well, I think that, I mean, it looks like their gas storage, they finally are at about 70%. They're hoping to get to about 80%, 90% by the end of November. So we'll see how that works out. I mean, they have, we have to see. I mean, there's so many ifs, ands, or buts during this, but
Right.
it looks bad. I mean, they're already preparing for rolling blackouts. The UK just announced rolling blackouts. I mean, you're already seeing, I mean, we've been seeing problems for even before the Russian invasion. Germany was having problems. Smelters were having, gas prices were still very high there because they're trying to transition too fast into green energy, and you can't have intermittent power sources as your base load. And so they've been having problems for, a couple of years. So we're definitely going to see more problems in that industry. Again, we're already seeing problems in their manufacturing sector. And they have already said that this winter, if we start having, to cut natural gas consumption, that's going to the commercial sector first before retail consumers. So that's definitely something, to watch out for. So I think it's going to be pretty bad.
Most people, when you say that they're going to have to cut back on the commercial sector first, they say, oh, well, that's not so bad. So the businesses can't turn up the heat in their offices. But they don't realize that you're talking about an input to so many of the goods they produce. It's not just about heating. It's about especially the chemicals.
Exactly. The chemical industry, and then it's contagion effect because the chemical industry affects the steel industry, that affects the car manufacturing industry. And so, you're talking about, and manufacturing is huge in Germany, right? That's their biggest sector. And so, if you start cutting those manufacturers out of gas, and they're trying to, we're seeing a lot of oil to gas switching where they're switching, the way that.
Yeah, right. Yeah, I heard that too.
They've got diesel to gas switching right now and oil from gas switching right now. And so they're trying to prepare, and they've, even coal, right? Coal is huge now, which is hilarious,
ironic, isn't it?
Given that they want to shut down their last 3 nuclear plants, but their coal consumption has gone way up. Does that make sense?
Yeah. Are they at all becoming more receptive to nuclear, or are they still on the nuclear's bad bandwagon, even with all these problems they're having?
Yeah, well, the chancellor just said 2 weeks ago, Schultz actually just said, I'm thinking about changing my mind on closing the last 3 nuclear plants by December. So It sounds like they're starting to come around. I know the UK is starting to come around. So, I think the more they start to feel the pain, I think we're going to see kind of a turnaround there. I mean, nuclear is very big, and most of the plants being built now are in Asia and Africa right now. So there is still huge demand for uranium. I know everybody likes to talk about uranium, but I do think we're going to start seeing kind of a turnaround. They're going to have to. Really, they have no other choice if they want to keep their climate goals.
That's really what's interesting. It's like how much pain needs to be absorbed by the general public before the politicians come to the conclusion that they're going to have to make some radical changes if they want that society to continue to vote for them.
Well, exactly.
That's the driving force behind these politicians, and then kind of reconciling that with the maybe even more macro objectives of kind of the global elite, the World Economic Forum types. It's just an interesting mix of variables here, to say the least. So moving forward, if you can add a crystal ball here for 2023, what do you see happening with the price of oil and energy prices? And I really want to talk about commodities as well.
Yeah, absolutely. Well, I think we're still, we're still going to have a shortfall. Demand is still expected to rise. We have OPEC that doesn't really have much spare capacity left. They still can't even produce what they're supposed to be producing. Right now, they still are at a 2.75 million deficit for, production deficit right now. Right. And so I think as soon as the SPR stops, which just so happens to be right at midterm time, I think that right. So I think that I think going into, during the winter, we definitely demand is less. But I think going into the last half of December, going into 2023, I think we're going to see another bounce in oil prices.
Yeah,
sure.
Because I think Eric was talking about that as well, where it's just all about you don't have the capacity to bring much more supply online, even if prices go up to 150 or who knows, maybe even higher than that. It's people think that you can just bring more oil online just by kind of flipping on a switch, and it doesn't work that way.
It doesn't work that way. And you have to look at, if you're looking at US producers, there's really no incentive to produce right now. They're being demonized by the government. They're being told they want to be phase them out. Who wants to invest capital doing that under those circumstances, right? And I have kind of heard that over and over again from, listening to earnings calls, especially from, the sort of mid to smaller tier.
Yeah. So I've had this idea that we're in a long-term commodity super cycle. I've been talking about it a lot. And I've actually kind of adjusted my portfolio to maybe take advantage of that. And I've noticed that these super cycles last maybe 10, 15 years. And so I think we'll look back at, April of 2020, when oil was negative $38 a barrel. And, we'll say, okay, that was probably a low point. And I know the commodity prices are extremely volatile. And in the way I like to invest, I just have this saying where, you just buy low, sell high. I like to say that you just buy things when they're cheap, sell them when they're expensive. And oil usually is pretty cheap, under 30 a barrel. But it's hard not to get involved or on the long side at even 80 or so, when you think that we're going into this long-term super cycle where oil could go up to 200-300. I mean, who knows how high it would go. So how, as a professional, how do you kind of manage your entry points, assuming that you're kind of bullish long term?
Yeah, I mean, I was, I obviously started being bullish, and after oil took a low, I mean, everything was so cheap. I mean, really, I mean, it's like 80% off. It's you got it, it was a deal, right? Yeah. I mean, it's kind of hard to get worse than that. So really, I mean, really what I do is, since I've, kind of had my base portfolio already completed and, by the end of 2020. So really, it's just kind of a matter of, easing up on, when we have these big bounces, easing up on, on my position size, and then, buying back lower. So, I'm kind of always trading around a core long position.
And how have you seen those commodity super cycles play out in the past? I'm sure you've studied that quite extensively. Are you in the same camp that we're most likely going to see commodity prices a lot higher over the next 10 years, even though we've got a lot of volatility in the interim?
Absolutely. I mean, we're set, because if you look at all the commodities, right, everything requires energy. So if you assume that you're going to have higher energy prices, that's higher input costs for everything, for agriculture, for metals mining, et cetera. And so, we're going to see higher commodity prices across the board because energy is the major input cost in all of those sectors.
Is there an argument that the cure for high prices is high prices? If oil gets up to 150, why couldn't we see another shale revolution or some sort of technology that's produced that will allow us to extract a lot more energy than we can extract right now, or maybe become far more efficient with the energy we use. Therefore, the demand goes a lot lower because we're able to satisfy our needs with a lot less than we're utilizing now. I mean, is there that argument, or what would be your rebuttal to that?
Yeah, yes, there is, improved efficiency. Look at automobiles, for example. How many, gallons, how many miles per gallon has that increased? So definitely you'll see more efficiencies. The problem is that right now, which we haven't seen in a very, very, very long time, is structural supply deficit across all of these commodities, right? So you're talking, and we have no capex, right? We haven't had no capex for the last 7 years in oil, no capex for the last 6 years in metals, right? So we're going to have to be playing catch up to that, and put on top of that is no one wants to produce because the whole industry is being demonized, right? And so I think our overlords, think that if we have higher, oil prices, that we're all going to go out and buy an EV. And, first of all, that's just not possible because our grid would crash immediately if that were to happen. And the thing is, all these people have these lofty energy goals as far as renewables and green energy, and the technology just does not exist yet.
That's the bottom line here is, I think when you're looking at the reduction in CapEx, and when you're looking at the pressures currently from the politicians, who knows where that goes, but definitely the pressures, I believe, will remain from the we'll call it the global elite crowd. They don't like holes being dug in the ground. And what's interesting is, in order to get to their objectives in 2030 or 2050 to go net zero, you've got to dig a lot more holes in the ground, or that's just the bottom line, regardless of the price. So how does that play out in your mind, that this push toward these agendas, while at the same time being very negative on drilling, energy use, and doing what you need to do to extract the copper, nickel, lithium, et cetera?
Well, they're unrealistic goals because they don't have the technology. Technology is just not there yet. They don't have the battery technology. The technology doesn't even exist yet to, have these goals. So, they think that just tomorrow we can turn around and, have renewables, and it's literally impossible. And so this is going to further exacerbate the problem, because at the same time they don't want fossil fuels or metals, they need those if they want to get their renewables, right? And so this is going to continue to cause problems. This is just the very start of problem. Literally what we're seeing in Europe right now is literally just the tip of the iceberg right now. And so, we're set to see a lot more problems because of how they are treating the industry, and the only industry that can help them get to their goals right now, unless, somebody discovers nuclear fusion tomorrow.
Yeah, exactly. That's a great point, that in order to get to the goals, they have to have the energy, but they're demonizing the energy industry that would allow them to get to the goals in the first place. And so what's the release valve there for investors? Is it just simply prices of commodities just have to explode?
There's no other, looking at, what is given at hand right now, there's no other way to look at the commodity industry right now. Prices are going to go higher as demand goes higher and production is slower or lower.
Yeah. And then how does that translate into food prices? Same thing.
So food prices are going to be, skyrocketing. My themes for the last couple of years have been agriculture, metals, and the energy sector.
Right.
So that's going to cause, again, energy is the major input. So this is going to cause prices to skyrocket, and there's no real way to stop that right now.
Is there anything that could, other than nuclear fusion or fission or whatever, that would get you to change your mind and say, okay, you know what, I that super cycle that I was 99% sure was going to pan out, now I'm second guessing that because of X, Y, and Z?
I would have to see something technology wise that appears that can efficiently take over, fossil fuels right now, and then that would suddenly change. But so far, I mean, there's just not, the technology doesn't exist yet. So I would have to see give me a technology that exists that is, just as efficient as the energy sector, right? It can't, except for nuclear, but,
in logistics too, though, Tracy, as you're saying that, I'm in Colombia and I was playing golf the other day with a guy that's very politically connected. He was a banker with Citi for 30 years. Then he retired to start investing in local mining projects here in Colombia. And he was telling me about what he has to do just to get to one of these places where they have this mine where he's investing. And I mean, it's like a flight on a puddle jumper. Then once you get off the puddle jumper, then you got to take like a Land Rover Defender or something like that. Some 4-wheel drive vehicle, like 2 hours, into the jungle to try to get here and there.
Oh, yeah.
I'm just, as you're saying that, I'm thinking, how would, even if we had a new technology, how would we be able to utilize that in the middle of a jungle?
I mean, along that same vein, I was just thinking about is, everybody wants all these metals for these, but nobody wants it in their backyard. So nobody, that would be great if we, they're looking at Arizona and we're looking at Nevada, and, all the environmental groups say, no, we don't want you to, dig a mine here. So that's the other problem that you're having. So everybody wants it in the middle of nowhere. And then to your point, how do you get it there? How do you get the technology there?
Yeah. You know what that reminds me of? The story of the migrants that are being shipped to Washington, D.C. and New York by the guy in Texas.
Right.
He says, sure, all the blue states want open borders or whatever it is they want, but all of a sudden when we ship those people to them, now it's a huge problem.
Now it's a problem, right? Even though they're sanctuary cities. So said it was a sanctuary city.
Yeah, but it's always that mindset. Let's raise taxes, but just on the other guy. Not me. Right. No. It's just incredible how that is so pervasive with the human condition, right? Okay, so technology might give you some pause as to this long-term commodity super cycle. We don't have anything on the horizon as of yet. So let's go back to you kind of trading around your core position, because this is, again, something I struggle with because of these, we'll just call them loose rules that I have for my own portfolio, where I don't like to buy something unless it's cheap. And oil right now, historically, when you adjust for inflation, it isn't really cheap because it only gets to that point when it's under maybe $30 a barrel. But there's such a awesome bull argument for it that it makes things very difficult. I went in and bought Russia when Putin invaded because Luke oil went down so much. I thought, well, oil's not cheap, but we've got a panic situation, and that makes the individual stock cheap relative to the price of oil even today, or even at $30 or $40 a barrel. Luke oil was really low. So how do you manage those entry points around your core position? When do you determine, okay, now's a good time to add to that long, or
Yeah,
maybe
I mean,
reduce the size?
I'm not trading. Well, let me specify. I'm not trading outright like crude futures, right? So, my portfolio is mostly, is all equities,
Mm,
basically. And, and maybe some calls on, on crude oil here and there. But I'm not really, trying to trade because the futures markets are so volatile.
yeah.
I prefer, say, the miners to trying to trade outright copper, right? And so when you see dips in that, then I look to what equities can I buy? What I prefer the miners right now over just straight basic or industrial metals, because I think they're going to see the benefit in the long run, and they're kind of lagging a little bit on oil. Like we've seen oil equities, we've seen producers and EMPs and services, et cetera, kind of have had a huge bounce. And we're kind of seeing metals have been kind of lagging this whole time.
Yeah.
And so, I think it's, now is really when I'm starting to, because we've also had a pullback. So now is really when I'm starting to look into the miners heavily.
And then what about coal? I wanted to talk to you about that because that's one of my favorite commodities. And the reason being is because I listen, my favorite investor of all time is Jim Rogers by far. And I was listening to his audiobook, Hot Commodities, the other day. It was probably a couple months ago, something like that. And he wrote that back in 2002, 2003. It came out in 2004. And he was talking about the last commodity super cycle. And this started in 96, 98, went to maybe 2011, 12. And I remember in the book, one of his favorite commodities was lead. And I'm when I heard that, I'm like, lead? Like, where do you come up with that? And the reason he liked it, number one, is because it was so hated. I mean, I'm sure you remember back in the late 90s. I mean, lead was like public enemy number one. I mean,
Oh
it's
yeah.
getting in kids' bloodstreams, and people were checking to see if it was in the paint in their walls. And I mean, everyone is freaking out about lead. And he said that you've got just this supply constriction because there's going to be zero capex because there's lead is uninvestable, quote unquote.
Right.
But he said you've got very inelastic demand. And he even made an argument for demand increasing due to China's GDP growth. And he was talking about how people, when they go from poor and they kind of go up the income level, they go from riding a horse to driving a motorcycle or a scooter to driving a car or a pickup truck, which I see every day here in Columbia. And he said those batteries for the motorcycles and the cars, they require lead. So everything that he was saying, you could have just inserted coal in 2022 or in 2020, 2021, and it would have been identical. The problem for me, though, is the coal price has skyrocketed, and I don't want to chase it out of FOMO. So what do I do?
So I mean, I've been in and out of the coal trade really, but I've been trading BTU because we have seen, look at Europe, right? Everybody's turning to coal now. They're even talking about consumers are buying in Scotland. You're allowed to burn coal at, domestic, like in your house for your heating. And they're having a run on coal for this winter. People preparing for this winter.
Yeah.
I mean, right? Who would have ever thought people were going to start burning coal in their stoves at their home again? Really?
Yeah. At what point will they start burning cow dung again? In Germany, that's going to be the next headline. They're going to start chopping down trees, the forests. No more Christmas trees. They've got to be used to burn to heat your house.
But yeah, I mean, back to coal, we're seeing India's been a huge buyer of coal lately. China hasn't backed off at all, on coal. So, definitely I like it. and I agree, it's super hated, but we are seeing a lot of, we're seeing a lot of new consumption.
Yeah, I just wonder how much the price could come down if we get a significant recession in the United States. I mean, even though demand is inelastic, the market still prices in an economic slowdown via commodity prices.
Well, what's interesting is, and I just wrote this up last week. What's interesting, because I was looking at Newcastle coal, which is the benchmark, Australian futures, compared to U.S. spot coal prices, and U.S. prices are basically half of what the Australian benchmark is, Newcastle coal. So, to me, that makes me a lot more interested in coal producers here, just because, if prices are half of what they are, say, coming from Australia, then even with the cost of shipping, I mean, you're going to have to ship anywhere you go in Australia, right? I mean, it's an island. So, in the United States, prices are in half. So the cost of shipping to Europe or whatever still comes in under what it would be for Australia, which is very interesting. So,
And that was the main reason for the premium there, Tracy, is because of the shipping costs are greater in the United States.
So yeah, I think it's just that demand, we're not seeing so much demand from the US right now. And so prices are still very high, but they're at least half of what they are coming from Australia.
Right.
That makes sense. And so, I'm kind of got me interested in, coal producers, particularly on like the East Coast.
Okay, so I'm assuming those prices are factoring in some political risk as well. Do you see that, or what's the?
Yeah, absolutely. I mean, everything is. I mean, oil. Oil has come off so much, but we're still at $87 a barrel. That would have been unheard of. I mean, before. So over the last few years, it hasn't been this high in years. So we're still seeing elevated commodity prices, even though a lot of them have come back. But yes, coal is still relatively elevated. But again, I think it's, not a bad time again to start looking at producers. I mean, they've already kind of spiked and come back down, but the whole commodity sector is kind of pulled back. So, when you're talking a pullback 30-40% that we've kind of seen, I think it's a good time to start, if you're not already in the market, to start at least looking at it if you have a long thesis. When you see kind of these big pullbacks, especially in like BComs pulled back a lot. So.
And those are those producers on the East Coast?
No, well, BTU is on the East Coast, but so look at producers in like Appalachian mountains, right? So because they have better access to shipping, right? Because they're closer to shipping than, say, Illinois, that's in the middle of the country.
Right. Yeah. There's a lot of logistical issues. So, and then how are those with a dividend yield?
So, I mean, I think they're pretty good, actually, right? I mean, because all of the energy sector in general right now, I mean, has great dividends because they're trying to attract investors, because it's been dead since 2000. I mean, if you look at energy alone, it went from 16% of weighting in the S&P 500 to 2 at the lowest. It's at 4 now. So all of these sectors, energy, metals, energy materials, they're all giving great dividends because they want investors.
Yeah, and I wonder if those dividends might increase if there's an argument for lower capex in the future. I wonder if that's an argument also for dividends, because they're just printing money. They're taking all this cash. What do they do with it if it doesn't go into expanding capacity? Maybe Exactly. It goes into just paying a higher dividend.
Yeah, absolutely. I think dividends you'll see more stock buybacks as well. I mean, we're seeing that across the board.
Yeah, that makes a lot of sense, doesn't it? All right. So you mentioned uranium a little bit earlier, so I definitely want to talk about that. What
Everybody
are your
loves talking uranium.
Yeah, I just got back from Rick Rule's conference in Boca Raton,
Ah,
and yeah, they were talking about, of course, uranium there. But I'd like to hear your thoughts.
so I mean, obviously, uranium's been a difficult trade. I mean, I've been in and out of that market for years, but I mean, it's been a difficult trade for years, right? And it's very volatile. But I do, I think that as we see kind of more of a Western mindset change a bit, and we are starting to see that, then obviously I think that's going to be very good for that trade.
Is the supply side as constrained as the oil market?
Well, it really depends. The supply side is not as constrained, but we have to look at big producers and processors, right? Which are like Kazakhstan, Russia, right? And so if we have, say, more, the West is diehard sanctions right now, right? And so if they want to continue with nuclear and they don't want to buy from Russia,
Yeah, right.
then prices are going to go up elsewhere.
Right. Yeah, because there's just very little. I mean, where do they produce it outside of Kazakhstan?
So I don't have a list off the top of my head right
Yeah,
now.
no problem. But that's definitely the major one for sure.
Yeah, exactly. And so you have to see if, like again, if the West, continues their sanctions against Russia, and then you also have to look at the end of the year, they're talking about Europe hasn't embargoed Russian oil yet, but said by the end of the year they want to embargo Russian oil. But the oil flows just stopped to Europe for 6 days on the on one of their pipelines, and they freaked out. So I'm not sure that they're going to be able to do that, but that's definitely something to watch, because if they do embargo Russian oil, it's not that Russian oil can't make it to other markets, but that's going to cause more problems within Europe as well.
I've got a stupid question for you. Is there any way to determine if the oil you have came from Russia?
Here you can tell the oil can, but if you refine it with something else, you have no idea. So in other words, India or China can buy cheap Russian oil, mix it with blend it, whatever, and sell it as gasoline or jet fuel or whatever anywhere else, and there's no way to tell.
Yeah, that's where I was going with this. When they first invaded and there was such a steep discount on Russian oil, I thought to myself, even if I'm like Saudi Arabia, why would I sell my oil? Why would I not just buy it from Russia and then resell it as my own? And maybe it's not that easy. They'd have to create some other product with it. But to a certain extent, it seems like an incredible arbitrage play.
And I'm certain that we saw an increase in Indian fuel cells exports. So where do you well, because they bought cheap Russian oil and now they're selling it as fuel to every other country.
Right. And the other countries can sit there and virtue signal because
Exactly.
they're no longer buying it directly, or they're no longer buying it from Russia. So they think it's just coming to them via India. And then Putin is still getting the money.
And also, I mean, Russia's also, which interesting is that Russia's also talking about, I mean, they're preparing for the worst, right? Which I would too. So they're talking about actually creating their own benchmark, because right now, how Russian oil is expressed is in a discount to Brent, because Brent is the benchmark. So if they create their own benchmark, euros as a benchmark, and sell it off their own trading platform, then it doesn't matter what the West says to them, because they've created their own benchmark, their own markets, and they already have a platform in place that's needs some work, but it definitely could be done by 2024, provided that they get enough offers, right, on the oil. But
right.
if they take it off the exchanges everywhere else, keep it on their own exchange, have it as a benchmark.
I see. So that would drive
then
up
you
the
would,
price. The price would explode on these other exchanges for
right.
a commodity that's identical. And so that would drive a lot of demand over to their exchange directly. Is that kind of how it would play
Well,
out?
it could. I mean, it's a way to completely avoid sanctions. And then you could, instead of using dollars in SWIFT, you could use the MIR exchange, the MIR exchange.
Or the China had one as well. I did a whiteboard video on it. I forgot what it was called, like SIPs or something like that.
Yeah. So you could use, one of those exchanges. But what it would do is that it would completely take off the market. I mean, this again, provided they had offers, right? I mean, if nobody, then that won't work. But if they do have offers, and what they're trying to do is get enough offers to, they would want to see if they could get enough offers to, actually make this like a permanent thing in their market. But what it would do is that they would be completely untouchable from the Western sanctions.
They should set up a GoFundMe campaign to try to measure to measure demand.
See how many people are interested in Russian Urals.
Yeah, exactly. Well, I didn't know that was playing out behind the scenes. So that's really fascinating. How do you look at what's happening with the BRIC countries kind of more coming together in terms of future commodity prices?
Yeah, I mean, that's really interesting too, because you have, Saudi Arabia, Iran, all looking to join BRICS. So I think it's in a kind of a shift away from the West, right? Because kind of the West is being crazy right now, to be honest, with all these sanctions. But, I think that a lot of people say it's going to strengthen things away from the dollar. I don't think that's necessarily true, because most of the time, everybody's trading dollars for these other currencies to buy commodities anyway, if they're purchasing them in, a different currency. It's just like, Europe got around sanctions. They're, buying gas in rubles. All they do is, they have an account at Gazprom Bank. They pay in euros or dollars, and the Gazprom Bank has a separate account, which they exchange the currency, and then Russia's paying rubles. So, I think that's, you're going to probably continue to see that happen, but, that's still going to just, I think it's still going to, strengthen the commodities markets.
And I just think of that in terms of global economic growth. I mean, you've got the Eurodollar system, something your partner Jeff talks about all the time. You had that thing running on all 8 cylinders prior to the GFC. And since then, it's been maybe running on, let's say, 4 cylinders. And if you have this bifurcation in the global economy, I don't know how that increases the efficacy of the Eurodollar market, therefore the access to dollar liquidity. And if they don't have access to that dollar liquidity, I don't know how the global economy in aggregate total continues to grow at the same rate, even the lower rate that we've seen since the GFC. It seems like a lot of disruptions there, and not just the supply chains, but the flow of liquidity.
Yeah, no, I agree.
So it sounds like you're someone that isn't too concerned about the dollar losing reserve currency status anytime soon, although we do see this move away from maybe trading in dollars and this move away from the current system we've had since pretty much 1950.
Yeah, I mean, I don't think we're going to lose reserve currency anytime soon. I don't think it's necessarily a bad thing that, we're seeing commodities traded in other currencies.
Yeah.
So, that's kind of my view right now. I don't think we're in danger yet.
Yeah, absolutely. That makes a lot of sense. So the main thing, just a selfish question here, is commodity super cycle. Definitely, you see it the same way I do. Same way Eric Townsend sees it, that there's very likely we'll have quite frankly, a crisis situation, and not just the energy space, but maybe even the metals space as an input to all these other goods that we use. and
Absolutely.
in the agriculture and food space as well. And so the viewer would be wise to maybe start positioning their portfolio accordingly. What I always suggest people do, because as you said earlier, commodity prices are so volatile. And even if they're going to be, 10 times higher in 10 years, let's say, it doesn't mean that you go there in a straight line. And a lot of people can't handle that volatility. So they end up buying at the tops and then selling at the bottoms. And
Right.
even though their long-term view plays out, they end up going bust, right?
Right.
So it's all about making sure that you have this long-term view. And I guess that's where people's focus needs to be, is on that long term, and then just doing whatever they can to go play golf in the interim, to where they're
Right.
not focusing on the.
You don't want to be staring at your portfolio every day if your time horizon is 10, 20 years, right? But I think that because commodities are so volatile, they do pull back a lot. That gives you a lot of opportunity to either trade around a core position, or if you are not vested in commodities, then again, recently we've had a pretty huge pullback. So, now might be time to start looking at some of those names, those commodity names.
Yeah, absolutely. All right, Tracy, for the viewers who want to find out more about what you're doing with Snyder and Steve Van Meter, where can they go check that out?
marketsinsiderspro.com. And so you can go there. You can sign up for free right now. We kind of started a couple of weeks ago. You can kind of read and see what we've been doing. Eventually it will be under a subscription, but for right now it's free. Go sign up, go see exactly, what we've been writing, kind of what it's about. And then, of course, I'm at Shy Girl on Twitter.
Awesome. Thank you very much for your time, Tracy. Good luck with the new apartment in Miami.
Thanks.